The biggest threat to the American dream was never inflation. It was never Jerome Powell, and it was never that guy on TikTok telling you to buy a house in cash. It's something far more boring than any of that. And it's something you've probably never heard about unless you've fallen deep into the finance rabbit hole at 2 a.m. on a Tuesday. And that's exactly why nobody's talking about it. Because if you've been wondering why home prices refuse to fall, while your rent keeps going up even though the economy feels terrible, and why buying a house feels like trying to buy a spaceship on a teacher's salary, the answer doesn't start with the Fed. It starts with a decision made 40 years ago and a math problem that nobody wants to solve. To understand the disaster we're currently living in, you have to rewind to the 1980s, because back then, America had a different housing problem. Mortgage rates were at 18%. 18%, which meant if you wanted to buy a $100,000 home, your monthly payment was roughly the same as a decent used car, a gym membership, and your entire personality combined. Nobody could afford to buy, so the government did what governments do when they want to look helpful without actually fixing anything. They made it easier to borrow. Fannie Mae, Freddie Mac, tax deductions on mortgage interest, 30-year fixed-rate loans for everyone. The whole system was basically engineered to make Americans buy houses. And it worked, maybe too well, because what followed was the longest, most uninterrupted housing price boom in American history. From 1990 to 2006, home prices doubled. Then 2008 happened, and everyone said, okay, we learned our lesson. Spoiler, we did not learn our lesson. After 2008, the Fed cut rates to zero and kept them there for a decade. And cheap money does one very predictable thing to asset prices. It makes them go up, a lot. From 2012 to 2022, median U.S. home prices went from $180,000 to $420,000. That's a 133% increase in 10 years. Meanwhile, wages? Up maybe 40%. So the gap between what homes cost and what people earn got wider and wider and wider. But here's where it gets interesting. Because in 2022, the Fed finally panicked about inflation and hiked rates from 0% to 5% faster than anyone expected. And the classic playbook said, higher rates equals lower home prices. Prices went down in 2008 when rates went up. Prices went down in the early 90s when rates went up. Basic economics, right? Except this time, prices didn't fall. And the reason why is the most important thing nobody explained to you. Meet Kevin. Kevin bought his house in 2021 at a 2.9% mortgage. His monthly payment on a $350,000 home? About $1,460. Life is good. Kevin is happy. Kevin has a dog named Stocks. Now it's 2026. Kevin got a new job in another city. He needs to move. So Kevin lists his house, sells it, and goes to buy a new one. Except now, mortgage rates are at 7%. That same $350,000 home now costs Kevin $2,330 per month. That's $870 more every single month forever. So Kevin does the math, looks at his dog, looks at his bank account, and decides he is absolutely not moving. Kevin is staying in that house until rates drop or until he dies, whichever comes first. And Kevin is not alone. Over 70% of American homeowners have mortgage rates below 4%. They are financially superglued to their homes, which means nobody is selling. And when nobody sells, supply disappears. And when supply disappears with demand still there, prices don't fall. They get stuck permanently, painfully high. It's like a game of musical chairs where someone glued everyone to their seats but kept adding new players anyway. So here's the uncomfortable truth that nobody on CNBC will say out loud. The US housing market isn't just expensive, it is structurally broken. And it's broken because of something called the lock-in effect, meeting the affordability ceiling at the exact same time. Let me explain. The lock-in effect means existing homeowners won't sell. Supply is frozen. The affordability ceiling means new buyers can't afford to buy. Demand is weakening. So you've got a market where nobody's selling and fewer people can buy, which in a normal market would mean prices crash. But here's the catch. The people who are buying, they're not your average family of four. They're institutional investors, private equity firms, companies that buy houses in bulk and rent them back to the exact people who can't afford to own them. And here's legendary investor Ray Dalio on what happens when an asset market gets this distorted. Watch the bond market. The bond market is the backbone of all markets. And when there is a breakdown of the supply-demand picture, you see a certain type of market action. Same principle applies to housing. When the supply-demand picture breaks, normal rules stop working. And right now, in American housing, the supply-demand picture is the most broken it has ever been. Let's just look at the raw numbers because they tell the whole story. Healthy housing market rule of thumb, home prices should be about 3 times annual income. Current median home price, $420,000. Current median household income, $80,000. Current ratio, 5.25x. To comfortably afford a median home today, you need to earn at least $110,000 a year. Only about 20% of American households earn that, which means 80% of Americans are priced out of the median home. This isn't a housing market, it's a housing museum. You can look, you can take photos for Instagram, but you cannot afford to live there. And before I get into what actually happens next, so what actually fixes this or breaks this? Because something has to give. Markets that reach least affordable in recorded history don't just stay there forever. There are really only 3 ways this ends. Option 1, the slow bleed. Rates gradually fall, lock-in effect slowly loosens, supply trickles back. Prices decline 10 to 15% over 5 years. Boring, painful, probably most likely. Option 2, the rate shock. Something breaks in the economy. Unemployment spikes. The Fed cuts rates aggressively. Mortgage rates drop fast. Lock-in effect disappears overnight. Suddenly, everyone sells at once. Supply floods the market. Prices drop 25 to 30% in 18 months. This is the scenario that keeps housing economists awake at night. Option 3, the plateau. Nothing changes. Prices stay high. Rates stay high. A generation of Americans just never buys a home. Homeownership rates fall. Rental nation becomes permanent. This is somehow the most depressing option, even though nothing explicitly crashes. Nobody knows which one plays out, but here's what we do know. The U.S. housing market in 2026 is the least affordable it has ever been. In history, ever. Not 2008, not the 1980s with 18% rates. Right now. And the duct tape holding it together is starting to peel. If you learned something today that your real estate agent forgot to mention, subscribe. Because every week I cover the financial stories that actually matter. No noise, no agenda, no $299 course to sell you. Just the boring stuff that somehow ends up being the most important stuff. See you next week.